Hey tech aficionados, welcome to the Friday edition of Tech Stocks Daily. We've got a jam-packed episode for you today. First up, we'll dig into CrowdStrike's legal woes and their stunning rebound strategy. Next, Apple flexes its strategy muscles in Hollywood while keeping investors smiling with dividends and buybacks. Then we'll talk about Uber's spooky new partnership with Spirit Halloween and their massive $5 billion credit boost. Finally, Baidu stock is soaring thanks to favorable economic moves in China and some serious tech innovation. Buckle up, it's going to be a wild ride. Hey tech enthusiasts, buckle up because today's top story centers around CrowdStrike Holdings, a big player in the cybersecurity space that's been both on a rocket and under fire lately. So why is CrowdStrike making headlines today? Let's break it down. The lawsuit drama. First off, CrowdStrike is currently embroiled in a class action lawsuit led by the law firm Kessler, Topaz, Meltzer & Check LLP. Investors who bought or otherwise acquired CrowdStrike stock between November 29, 2023 and July 29, 2024 are claiming that CrowdStrike's management made some pretty alarming oversights. The lawsuit alleges that the company's procedures for updating its Falcon software platform were seriously flawed. According to the complaint, CrowdStrike didn't adequately test updates, which led to gigantic outages for their customers. Imagine updating your security software and accidentally making everything less secure. Yikes. As you can imagine, this series of unfortunate events caused investor panic and significant reputational harm, driving CrowdStrike stock to trade at artificially high prices during the period leading up to the revelation. Now, the lead plaintiff deadline in this case is fast approaching, September 30th, 2024. So if you've got a bone to pick, get those claims in pronto. The IT outage catastrophe. Speaking of swing and a miss moments, the lawsuit isn't the only dramatic plot twist. CrowdStrike was also responsible for one of the largest IT outages ever, thanks to a glitchy software update on July 19th. We're talking canceled flights, financial institutions grinding to a halt, and investors losing their cool. The stock's value plummeted by over 40% within a month. But wait, there's more. Bouncing back? Despite all this turbulence, there's a silver lining that has investors cautiously optimistic. CrowdStrike's co-founder and CEO, George Kurtz, dropped a bombshell at the company's Falcon conference on September 17th. Kurtz confidently proclaimed that CrowdStrike's pipeline generation, essentially its ability to bring in new deals, has rebounded to pre-incident levels. And believe it or not, CrowdStrike hasn't lost its ambitious streak. They've got their sights set on generating over $10 billion in annual recurring revenue by 2030. Just for comparison, they were at $3.8 billion as of their fiscal Q2 of 2025. That's a big leap, and it seems they're staying on track despite the recent hiccups. Returns, returns, returns. Now let's switch gears and sprinkle in some good news. Compounded returns. If you had invested $100 in CrowdStrike stock 5 years ago, that investment would be nearly $500 today. That's an annualized return of around 37.61%, massively outperforming the market average by 23.32%. Even after a roller coaster year, they've proven there's some serious staying power there. The bottom line, CrowdStrike is an incredible narrative of highs and lows, embodiments of why cybersecurity remains such a high-stakes dynamic frontier. While their recent woes have had Wall Street in a tizzy, their ability to rebound and maintain a growth outlook might just make them a phoenix rising from the ashes. So whether you're a current or prospective investor, a tech aficionado, or just someone who loves a good comeback story, keep your eyes on CrowdStrike. Hey tech enthusiasts, buckle up because today's tech headlines are all about Apple. And trust me, it's like biting into a juicy Mac, pun intended. So what's cooking in Cupertino? First up, Apple has been shaking things up in Hollywood. It looks like Apple TV Plus is getting a bit of a makeover to curtail those big-budget movie rampages. Apple reportedly aimed sky high, but the gains didn't quite match those ambitions. The company splurged about $700 million on 3 blockbuster movies, Killers of the Flower Moon, Napoleon, and Argyle. The return on that investment? A global gross of $470.4 million. You don't have to be an accountant to see the math, there isn't adding up. So what's the new game plan? Apple plans to hit the brakes a bit, producing around a dozen movies annually, with most of them costing less than $100 million. It seems like Apple's strategists Zach Van Amberg and Jamie Ehrlich are thinking quantity and quality, but with a firmer grip on the budget. The Hollywood pivot comes in the ruthless battleground of streaming services, where Netflix reigns supreme with a solid 22% market share. Apple TV Plus, while scrappy, sits at 9%. So it's time to roll up those sleeves, right? But fret not, Apple is still pulling out some big guns. Remember George Clooney and Brad Pitt? Apple's recent action comedy Wolves, featuring the duo, opted for a limited theatrical run before hitting the streaming platform. Another potential hit on this route is the World War II drama Blitz. Apple aims to sprinkle a bit of that Hollywood magic dust theatrically before bringing it home for your steaming pleasure. Moving right along, grab your wallets, shareholders. Apple has been doing wonders for its investors. Despite a slight stall in sales growth, Apple's stock has delivered a delightful 31% return over the past year. That's partly because the company has been incredibly good at spreading the love, or should I say, the cash. Apple recently upped its quarterly dividend to 25 cents per share, By the end of 2024, that will likely total up to 99 cents per share. Considering Apple has been paying and increasing its dividends for 13 consecutive years, this is like an annual tech Christmas. What's more, with a payout ratio of just 14.9%, Apple has loads of room to maintain and even crank up those dividends annually without breaking a sweat. Oh, and did I mention the $110 billion share repurchase program? Talk about being generous. With a strategy that includes reducing outstanding shares by 14.5% over the past 5 years, Apple is keeping its shareholders grinning from ear to ear. So there you have it. Apple's making significant movie strategy shuffles while keeping their investors smiling with dividends and stock buybacks. It's a fascinating balance of tightening their belts in Hollywood while doling out a financial feast for shareholders. Stay tuned because the tech giant is clearly not resting on its laurels. And yes, stay optimized, stay amazing. All right, folks, let's dive into why Uber Technologies is making waves in today's tech news. First up, Uber has teamed up with Spirit Halloween to add a festive twist to its on-demand delivery services. That's right, now you can order your Halloween costumes and spooky decorations straight to your door through Uber. The Spirit Halloween catalog will be available on Uber at the same prices you'd find in store, making shopping for costumes this year as effortless as summoning a ride. But that's not all. Uber One members get an extra treat. Members can enjoy a $0 delivery fee and a 5% discount on Spirit Halloween orders over $35. Even if you're not a member, no need to feel like a ghost. You can still snag up to 40% off your next Spirit Halloween purchase of $50 or more through Halloween. Beryl Sanders, the director of U.S. grocery and retail partnerships at Uber, even chimed in to say, "That's one of the reasons we're most excited to bring Spirit Halloween to Uber Eats and our other Uber apps, to make costumes and other Halloween must-haves a cinch." Now, shifting gears from spooky season shenanigans, Uber also announced it has secured a monumental $5 billion revolving credit facility with Bank of America. This move replaces an older agreement from 2015 and offers Uber plenty of financial flexibility. The loans mature in 2029, giving them a comfortable runway for future plans and innovations. They can draw these funds in US dollars or other currencies, versatile options that could serve all sorts of corporate purposes. Let's break down the nitty-gritty of this loan agreement. It features interest options tied to either the term SOFR plus a 1% margin or a base rate with no margin, and it has a commitment fee that starts at just 0.25% annually. The rates and fees will wiggle around based on Uber's debt ratings, adding a layer of financial strategy to the mix. There are also some covenants and default conditions to heed. Uber must maintain a minimum EBITDA to interest ratio of 3-to-1, but currently, they're not borrowing any new money. They just transitioned $413 million in letters of credit from the old agreement into this new one. This indicates financial health and a measured approach to future borrowing. Lastly, if you want to bet on Uber's stock performance without directly buying shares, you can gain exposure through ETFs like the iShares US Transportation ETF or the Franklin Disruptive Commerce ETF. They include Uber stock, letting you spread the investment risk across multiple companies. So from riding waves in the fintech world to becoming your Halloween hero, Uber is covering all fronts. Whether you're into financial maneuvers or you just need a last-minute costume, Uber's got you covered. Hey tech enthusiasts, let's get into why Baidu is lighting the tech world on fire this week. All right, gather round because Baidu Inc. is the talk of the town with an impressive surge of about 22%, pushing its stock price up to 106.09 cents. What's the buzz all about? Well, it's a potent mix of favorable economic conditions in China and some promising growth outlooks for the company itself. Let's start with the macroeconomic tea. The People's Bank of China has dropped some major fiscal goodies. They've slashed the reserve requirement ratio for banks by 50 basis points, down from 10.0% to 9.5%. This might sound like dry financial jargon, but here's the juicy part. It's an aggressive move that frees up about 1 trillion yuan to pump into the banking system. Picture it as giving the banks a massive energy drink so they can lend more freely to businesses. And just when you thought they were done, nope. The PBOC also lowered both the 7-day and 14-day repo rates, reinforcing its commitment to breathe more life into China's economy, particularly as it struggles with a property market crunch and flagging consumer confidence. It's like the central bank is saying, "Fear not, we've got your back." So, why does this matter to Baidu? Well, more liquidity means better access to capital. For a tech giant like Baidu, which has vested interests in high investment sectors like AI, cloud computing, and autonomous driving, this is fantastic news. More capital means they can turbocharge their initiatives, especially their AI technologies. Think Ernie Bot, which is giving OpenAI's ChatGPT a run for its money. But wait, there's more. There are whispers that China might roll out a $284 billion fiscal stimulus package, which could significantly boost sectors like AI, smart cities, and autonomous driving, all areas where Baidu has poured in significant resources. This aligns perfectly with China's broader ambitions to close the technology gap with the US, making Baidu a star player in their high-tech agenda. Now it's your turn. What do you think about Baidu's surge in the market? Is this a flash in the pan, or are we looking at sustained growth fueled by favorable policies and innovative strides in AI and tech? Are you investing, or are you cautious about diving into the Chinese market right now? Don't be shy. Drop your thoughts in the comments below. I can't wait to hear what you all think about Baidu's big week. Let's chat. All right, tech enthusiasts, let's dive into the grand question. Would I sell, buy, or hold any of these stocks given today's news? Let's focus on CrowdStrike holdings. To sell, buy, or hold? Given the recent action-packed drama surrounding CrowdStrike, here's what I'd do. Why hold? 1. Lawsuit drama. Yeah, the class action lawsuit against CrowdStrike is a serious bump in the road. Investors are fuming about alleged flawed processes in updating their Falcon software platform, leading to debilitating outages. However, lawsuits like these eventually water down as companies either settle or manage to fix the issues. It's part of the ride. 2. IT outage catastrophe. The massive IT outage was undoubtedly a colossal setback. The stock took a nosedive, losing over 40% of its value in under a month. But look at it this way, the tech sector loves a comeback kid. The rebound potential here could be electrifying. 3. Rebounding pipeline. Some good news at last. CrowdStrike CEO George Kurtz unveiled at the FAL.con conference that their pipeline generation is back to pre-incident levels. This means they're hustling hard to recapture market confidence. They even have an ambitious $10 billion annual recurring revenue goal by 2030. Talk about swinging for the fences. 4. Historical performance. Let's gaze into the rearview mirror for a sec. If you invested $100 in CrowdStrike 5 years ago, that would be nearly $500 today. An annualized return of around 37.61% comfortably smokes the market average. Even though they've hit a road bump, their historical performance suggests some serious resilience. The reality check. Risk versus reward. The legal and operational hurdles are real, but not necessarily fatal. Companies in the tech and cybersecurity fields often face technical challenges. CrowdStrike has shown it's capable of rebounding. Economic climate. With increasing cyber threats globally, the need for robust cybersecurity solutions isn't going anywhere. CrowdStrike is still a top contender in this space. The bottom line, hold tight, folks. There's enough in CrowdStrike's pipeline to suggest they could bounce back stronger than ever, assuming they cope effectively with their current challenges. But always remember, the best defense is thorough research. Dig deep into quarterly reports, consult trusted financial advisors, and keep an eye on updates before making any decisions. Because hey, while my 2 cents can provide some clarity, your financial intuition is priceless. So what do you all think? Is CrowdStrike your cybersecurity superstar or a rocket ship running low on fuel? Drop your thoughts in the comments. Whoa, what a ride today in the tech world. CrowdStrike is navigating some stormy seas with lawsuits and IT hiccups, yet showing promise with strong pipeline recovery. Apple is tightening Hollywood's purse strings, but making investors smile with juicy dividends and buybacks. Uber's all geared up for Halloween and financial bolstering, while Baidu is getting a major boost thanks to favorable economic policies in China. If you enjoyed the breakdown, don't forget to like, subscribe, and share this video. And hey, join me on Monday for more tech buzz. Have an awesome weekend, everyone.